Welcome to UXL, where you can learn new skills anytime and anywhere. Visit uxl.com to explore our full course selection. This lesson is part of a larger course. Check the video description below for a link to the full course where you can enroll. If you enjoy our content, please like and subscribe. For your convenience, the course cover displayed on your screen provides the complete course title and lesson title. Let's proceed with the lesson. Lesson: Exploring Traditional Cost Management Frameworks. Traditional cost management frameworks have long served as the bedrock of financial planning and control within organizations. These frameworks provide a structured approach to understanding, controlling, and optimizing costs, ensuring that resources are efficiently allocated to achieve business objectives. The primary goal of traditional cost management is to enhance profitability by reducing unnecessary expenses and improving operational efficiency. One of the most widely recognized traditional cost management frameworks is standard costing. This method involves establishing predetermined costs for products and services, which serve as benchmarks against actual costs. The variance between standard costs and actual costs is then analyzed to identify areas of inefficiency and implement corrective actions. Standard costing is particularly useful in manufacturing environments where production processes are repetitive and costs can be accurately predicted. By comparing standard costs to actual costs, management can pinpoint deviations and take steps to address them, thereby maintaining cost control and enhancing profitability. Another traditional cost management framework is activity-based costing. Unlike standard costing, which focuses on direct costs, ABC allocates both direct and indirect costs to activities based on their consumption of resources. This approach provides a more accurate picture of the true cost of products and services by highlighting the cost drivers behind various activities. For instance, in a manufacturing setting, ABC might reveal that a significant portion of overhead costs is driven by quality control activities. By identifying these cost drivers, management can make informed decisions to streamline processes and reduce costs. ABC is particularly effective in complex environments where indirect costs constitute a substantial portion of total expenses. Job order costing is another traditional framework that assigns costs to specific jobs or batches of products. This method is commonly used in industries where products are customized or produced in small quantities, such as construction, printing, and specialized manufacturing. Under job order costing, direct materials, direct labor, and overhead costs are tracked for each job, providing a detailed view of the costs associated with individual projects. This level of granularity enables managers to assess the profitability of each job and make adjustments as needed to improve cost efficiency. For example, a construction company might use job order costing to evaluate the cost-effectiveness of different building projects and identify opportunities for cost savings. Process costing, on the other hand, is suited for industries where production processes are continuous and products are homogeneous, such as chemicals, food processing, and petroleum refining. This framework accumulates costs by process or department over a specific period and then averages these costs over the units produced. Process costing provides a clear understanding of the cost per unit, which is essential for pricing decisions and profitability analysis. For example, a food processing company might use process costing to determine the cost per unit of packaged goods, enabling it to set competitive prices while ensuring profitability. Traditional cost management frameworks also include absorption costing, which allocates all manufacturing costs, both fixed and variable, to products. This method ensures that all production costs are accounted for in the cost of goods sold, providing a comprehensive view of product costs. Absorption costing is required under generally accepted accounting principles for external financial reporting, as it ensures that inventory valuations reflect the full cost of production. However, it can sometimes lead to overproduction and inventory buildup, as fixed costs are spread over more units, reducing the cost per unit. To mitigate this risk, managers must carefully balance production levels with demand to avoid excess inventory and associated carrying costs. Despite their widespread use, traditional cost management frameworks have limitations. One common criticism is that they often rely on historical data, which may not accurately reflect current market conditions or future trends. For example, standard costing and absorption costing are based on predetermined costs and fixed overhead rates, which may not adapt quickly to changes in production volume or economic conditions. Additionally, these frameworks may not fully capture the complexity of modern business environments where indirect costs and overhead expenses play a significant role. To address these limitations, organizations increasingly complement traditional cost management frameworks with more dynamic and forward-looking approaches. One such approach is target costing, which starts with a market-driven price and works backward to determine acceptable costs. This method encourages cross-functional collaboration and innovation to achieve cost targets while meeting customer expectations. For example, an electronics manufacturer might use target costing to design a new product that meets market price expectations while controlling production costs. By focusing on market demands and cost constraints from the outset, target costing helps organizations remain competitive and profitable. Another complementary approach is Kaizen costing, which emphasizes continuous improvement and incremental cost reductions. Kaizen costing involves setting cost reduction targets and systematically identifying and implementing cost-saving measures. This approach fosters a culture of continuous improvement and employee involvement, leading to sustained cost reductions over time. For instance, a manufacturing company might implement Kaizen costing by encouraging employees to suggest process improvements and cost-saving ideas, resulting in ongoing efficiency gains and cost reductions. In conclusion, traditional cost management frameworks such as standard costing, activity-based costing, job order costing, process costing, and absorption costing provide valuable tools for understanding, controlling, and optimizing costs. These frameworks have proven effective in various industries and business environments, offering structured approaches to cost management and profitability analysis. However, they also have limitations, particularly in their reliance on historical data and their ability to capture the complexity of modern business operations. To address these limitations, organizations are increasingly adopting complementary approaches such as target costing and Kaizen costing, which emphasize market-driven pricing and continuous improvement. By integrating traditional and modern cost management frameworks, organizations can achieve a more comprehensive and dynamic approach to cost management, ultimately enhancing their competitiveness and profitability. This concludes the lesson. We trust you found this video informative and engaging. To enroll in the complete course, please use the link provided in the description below. At UExcel, we are committed to your learning journey. Each course offers a certificate of completion, online support, and downloadable resource files to enhance your experience. If you found our content valuable, we invite you to like this video and subscribe to our channel. Thank you for joining us, and we look forward to supporting your continued pursuit of knowledge.